Have you ever wondered whether sports cards could actually play a role in your retirement portfolio? Well, for decades, baseball cards, basketball cards, and football cards have been viewed as collectibles, something you put in a shoebox or a binder and show your friends. But in recent years, especially with the explosion of high-end auctions, record-setting sales, and Wall Street-level money pouring into the hobby, investors are starting to ask a serious question. Should I allocate part of my retirement savings to sports cards? Today I'm going to walk you through the pros and cons of doing just that. We'll talk about why sports cards have gained attention as an alternative investment, but also why you need to be very cautious because this is not your typical government-sponsored retirement account. By the end of this video, you'll know whether carving out a small portion of your wealth for sports cards might make sense for you or whether it's better left as a hobby. Sports cards, particularly vintage cards of Hall of Famers and rookie cards of iconic players, have become an asset class of their own. We're talking about Babe Ruth, Mickey Mantle, Jackie Robinson, Michael Jordan, Wayne Gretzky, Tom Brady, the legends. High-grade PSA slabbed examples of their rookie cards have appreciated tremendously over the last few decades. In fact, some cards have far outpaced traditional stock indexes like the S&P 500 over certain time frames. That's what gets investors excited, the possibility of non-correlated growth. When the stock market is down, sometimes the sports card market keeps chugging along or even explodes upward as collectors and investors chase rare supply. But just because something has gone up in value historically doesn't mean it should automatically be part of your retirement strategy. Let's look at the case both for and against allocating retirement dollars to sports cards. First, the pros. Pro number one, diversification and non-correlation. One of the strongest arguments in favor of sports cards is that they don't move in lockstep with stocks and bonds. If you think of your retirement portfolio as a pie chart, sports cards represent a slice that isn't directly tied to Federal Reserve policy, GDP growth, or corporate earnings. That non-correlation can provide a cushion against volatility. Pro number two, historical appreciation of vintage Hall of Famer cards. The vintage market, especially pre-1980 Hall of Famers and key rookie cards, has shown steady appreciation. A 1952 Topps Mickey Mantle, a 1933 Gaudy Babe Ruth, or a 1986 Fleer Michael Jordan rookie card, these are iconic pieces of Americana with global demand. Over time, scarcity plus cultural significance has driven their values higher. Pro number three, tangible enjoyment. Unlike a mutual fund statement, you can actually hold, display, and enjoy a sports card. There's an emotional dividend, something that doesn't show up in your account balance but can enhance your overall quality of life. If you grew up idolizing a player, owning their rookie card in PSA 8 or PSA 9 condition brings a kind of joy that no ETF can match. Pro number four, market growth and institutionalization. With grading companies like PSA and Beckett, vault services, insurance products, and even fractional ownership platforms, the sports card market has become more sophisticated. That infrastructure makes the asset more accessible and some argue more investable than ever before. Now let's pump the brakes because there are some major drawbacks to keep in mind. Con number one, sports cards are not IRA eligible. This is a big one. You cannot buy sports cards inside an IRA or Roth IRA. The IRS doesn't recognize them as a qualified investment vehicle. That means you don't get the same type of tax treatment as you would inside a traditional government-sponsored investment account. Con number two, higher capital gains rates. When you sell a stock you've held for more than a year, you pay long-term capital gains rates, usually 15 or 20% depending on your income bracket. But sports cards fall into the collectibles category. That means they can be taxed at the lower of your ordinary income tax rate or 28%. Throw in state tax and you could give up almost a third of your profit to Uncle Sam. Con number three, illiquidity and transaction costs. It's not like selling a share of Apple stock with a click of a button. Selling a high-end sports card might require an auction house, which takes a hefty seller's premium of up to 22%. Even selling on eBay comes with fees, shipping risks, and potential disputes. Sports cards are less liquid than traditional assets. Con number four, volatility and speculation risk. Not all cards go up in value. In fact, many modern cards, even of star players, lose value over time because the supply is so high. Speculating on the next big thing in sports cards is no different than chasing a hot stock tip. You might get lucky, but you could just as easily get burned. Con number five, emotional bias. Let's face it, if you're a lifelong Yankees fan, you might convince yourself that Derek Jeter rookies are the best investment on earth, but emotion doesn't always align with market reality. This emotional attachment can cloud judgment, leading to poor investment decisions. If after hearing both sides you still want to include sports cards in your retirement strategy, here are 5 principles to help keep you safe. Limit your exposure to no more than 5%. This is critical. Sports cards should never be more than a tiny sliver of your retirement portfolio. If your retirement savings total $1 million, that means no more than $50,000 allocated to sports cards. That way, even if the market crashes, your overall retirement security isn't jeopardized. Focus on vintage Hall of Famers and rookie cards. The safest corner of the sports card market has always been vintage Hall of Famer rookie cards. We're talking Mickey Mantle, Willie Mays, Hank Aaron, Jackie Robinson, Babe Ruth, Roberto Clemente. These names are etched in history. Their careers are over. They aren't going to get embroiled in any scandals, and their supply is permanently capped. Stick with graded cards. Condition is everything. A PSA 8, 9, or 10 commands exponentially higher prices than raw cards. Professional grading eliminates some of the subjectivity and protects you against counterfeits. Buy the card, not the hype. Don't chase the latest prospect or overhyped release. Focus on Hall of Fame players whose careers are long since past. Highly sought after rookie cards are always your best bet. Plan for taxes and fees. Factor in the 28% capital gains rate, the auction house commission, and shipping costs. Don't assume your gross sales price equals net profit. So, should you allocate a portion of your retirement savings to sports cards? The answer is maybe, but carefully. If you're financially secure, your retirement plan is already on track, and you want to carve out up to 5% for something tangible, enjoyable, and potentially profitable, then yes, sports cards could make sense. But if you're still building your retirement foundation, or you're tempted to go all in on cardboard as a shortcut to wealth, that's a recipe for disaster. Remember, sports cards should only ever be a small supplement to your retirement portfolio, not the foundation. Stocks, Roth IRAs, annuities, life insurance, that's your core. Sports cards are the spice you sprinkle on top. So there you have it, the pros and cons of allocating retirement savings to sports cards. What do you think? Would you ever consider adding sports cards to your retirement portfolio? Drop your thoughts in the comment section below. I'd love to hear your perspective. And if you found this video helpful, make sure to like, subscribe, and share it with a fellow collector or investor. I'm David McKnight. Thanks for watching. I'll see you on the next video.